Now we are in the next session of the course. In the last class, what you see on the screen is what we talked about in the last class. That is, we talked about the what do you call it as the profit and loss statement and the income statement, and we also talked about the balance sheet of the company out there. We also talked about the balance sheet. And when I talked about the balance sheet, I specifically said that the balance sheet is as on a specified date, on a specified time, on a specified day, what is the position of what you own and what is the position of what you owe out there, and that is what you see out here on the right side, which I have highlighted. Whereas when I talk about the income statement, we always say income statement is more to do with what we call it as for a period of time out there. During that particular period of time, whatever income generated, whatever revenue generated, whatever expenditure incurred out. Again, I am going to go back to this discount. I am very sure still there are some of you would still have a doubt with regard to discount. I said, why is discount received of 25,000 put in the revenue part of your income statement out there? Now, what happened in that case? You go back to your earlier transaction. You received 3 lakhs worth of material from somebody and you owed that person 3 lakhs out there, and that is what was written out here in the creditors. You can see my toolbar out here, which is highlighted out there on the screen. You can see that 3 lakhs out there. And when you had to pay, maybe because you paid early than before the due date, or whatever may be the reason out there, let us not even get into the reason. That person gave you a discount of 25,000. He said you paid 2,75,000 and he said it's full and final, the settlement is over. That means what has happened? You have got 3 lakhs worth of goods. You have paid only 2,75,000. That means you have got 25,000 worth of goods extra with you. Somebody has not given you cash. When you sell goods, you get cash. Somebody has not given you cash. Somebody has instead said that I will give you, what do you call it, as 25,000 rupees worth of goods to you. So it is something which you have received, which is a benefit which you have received. So obviously it is equivalent to your revenue. That is how we basically take that discount received. That is, he has not given you cash, he has given you in the form of material worth 25,000. It's a receipt. So when I say revenue, revenue need not always mean cash inflow. Please understand that. Revenue means, as I said in the first class itself, the profit or loss or the income statement is always on an accrual basis, number one. And that is whatever has accrued, whatever benefit has accrued to you, revenue benefit has accrued to you, all that we record, irrespective of whether you have received it or not. Same is the case irrespective of whether you have paid or not. We are looking at recording what has accrued out there, and that is what you see out here. Okay. Now, having said this, I am just going to move to the next stage today. That is, in the next stage today, what you see out here, I have already uploaded an exercise that is called as case on Lone Pine Cafe A. This is also from the second chapter of the textbook that I have indicated as a for this particular course out there. Textbook on accounting, text and cases by Anthony and East. And then from the textbook in chapter 2 you find this particular case, and I am just going to solve this particular case or the exercise out. Now what are we looking at? Let us just move to what is required out here. They say that prepare a balance sheet for the Lone Pine Cafe as of 2nd November 2009. Prepare a balance sheet of the as of March 30th, 2010. Why have they asked me to prepare these two balance sheets? Let us go back and read through this entire case. If you read the case, it says that on 31st of March 2010, The partnership that had organized to operate the Lone Pine Cafe was dissolved under unusual circumstances, and in connection with its dissolution, preparation of a balance sheet became necessary. So, what is happening? The second question out here is, on the day the entity was dissolved, they are asking me to prepare a balance sheet, that is 31st of March it was dissolved. So, the previous evening they are asking me to prepare this particular balance sheet out there, and that is what we see the second question. Now, what is the first one out there? The partnership was formed by Mr. Mrs. Henry and Mrs. Sandra Landers, who became acquainted while working in a Portland, Oregon restaurant. On November 1st, 2009, each of the partners contributed $16,000 in cash to the appropriate partnership and agreed to share in the profits proportionally to the contributed capital. So, what is happening? On 1st of November, basically they start operating a cafe, and if you read the question out there, that is, on the day you start the cafe, after you start the cafe, they want you to prepare the balance sheet out. After you open the cafe, that is, on the day you open the cafe, they want you to prepare the balance sheet. They want you to prepare the balance sheet. Basically, there are two balance sheets which we prepare. One, the day on which the cafe is opened. Number two, on the day the cafe was wound up out. Now, as a first step, I am going to go back to my Excel sheet out here. I am going to go back to my Excel sheet out here, and let us look at preparing an opening, that is when the entity was started. Let us prepare a balance sheet when basically the entity was started out there, that is balance sheet or opening balance sheet of Lone Pine as of November 2, 2009. Let us prepare an opening balance sheet out. That is, what are we preparing? We are preparing only the list of things that the entity owns as of November 2nd, and list of things that the entity owes as of November 2nd. That is all. So, we say what is it that the entity owns, what is it that the entity owes as of November 2nd, 2009, that is when the cafe basically opened out there. I am going to go back to the statement out here. If you read through this, let's go back and read through this. They said that on November 1st, each of the three partners contributed $16,000 in cash to the partnership and agreed to share the profits proportionally to the contributed capital. So, moment if I am just taking this statement out there, how will it reflect in your balance sheet out there? Let us go back to your balance sheet, how it will reflect like, that is capital. We are preparing the balance sheet for Lone Pine Cafe. So, the Lone Pine Cafe owes the money back to the person who has contributed, they wind up out there. So, what is the capital? Capital by what is contributed, what is the name of the people out there? Let me just, Mr. and Mrs. Henry. Mr. and Mrs. Henry, what is the kind of capital, but they are basically looking at contributing out there. That is, they have contributed $16,000 each, and the two of them, so that is about $32,000 is what they have contributed as capital. Next, the statement also says that there is one more partner, Mrs. Sandra, that is capital contributed, capital by Mrs. Sandra. What is the kind of capital? Capital by Mrs. Sandra is, again, she has contributed how much? They have contributed about $16,000 as capital. Now, they have contributed in the form of cash. When they have contributed in the form of cash, the cash is sitting in the cash box of the cafe. Now, who owns the cash? It is not the three partners. The three partners have given the cash to the company, to the cafe. The cafe owns the cash. So, the cash basically as of now is basically owned by the cafe out there. What is the cash? That is 16,000 into 3 of them, that is 48,000 is the cash that is basically owned by the cafe out there in this part as of now. So, that is what basically we see. And let us look at, sir, somebody can say, oh, do we have total? Yes, we can total it out here, and basically you can see that the total of both the liabilities and equity as well as the what you own basically matches in this particular case out there. I move further out here. Mrs. Anthony's contribution represented practically all their savings, and Mrs. Lander's payment was the proceeds of the late husband's insurance policy. Let's leave it there. Let's not get into the details of it. On that day, also the partnership signed a 1-year lease to the Lone Pine Cafe located in a recreational area. They have signed a lease. There is no transaction that has happened. It's a lease I have signed. I am going to pay some amount. If I pay some amount, yes, transaction. As of now, I have not paid anything. So, when I have not paid anything, there is no financial transaction that has taken place. Sir, you have to pay lease rent. Yes, you have to pay lease rent. That is at the end of the period you have to pay lease rent, whatever is agreed. If at the end of every month, at the end of fortnight, whatever it is. As on the day you sign the lease, there is no what is called as obligation, because you have not enjoyed the benefits of it. The monthly rent of the cafe was 1500. On November 2nd, there is no monthly rent is 1500. Rent is not due. Rent is due only at the end of the month. So, as of day, as of November 1st or 2nd, there is nothing due in that case. The facility attracted partners in part because they were living accommodation on the floor above the restaurant. One room was occupied by Mrs. Antonio and the other was by Mrs. Landers out there. Antonius and the Landers. That's okay. The partners borrowed 21,000 from a local bank. Let us stop it here. Let us not continue reading the sentence. Let us stop this here. And then let us sort of see how it reflects in your Excel sheet. The partners borrowed 21,000 from a local bank. I go back to my Excel sheet out here. I go back to my Excel sheet. When you borrow from a bank, what happens? The liability increases. What happens? The liability basically increases in this particular case. What is the amount borrowed? 21,000 is the borrowed amount. When you borrow, you owe the money back, but you have the cash. The cash basically what you have is belongs to the enterprise, belongs to the cafe out there, belongs to the cafe out there, belongs basically to the cafe out there. As far as the cash is concerned, it basically belongs to the cafe out there, and I am very sure a lot of you have a lot of doubts out here. Now, let me come back and explain. Sir, it's a loan. How is it an asset? It is a loan. I have taken a loan. It is not an asset for me. Now, let me take a very simple example. You go to the bank and take a loan of $21,000. Fortunately or unfortunately, that fellow is giving you cash of $21,000. That $21,000 is a loan. Agreed. Now, he has given you $21,000 in bundles of $100 bills out there. You have taken the $21,000. Now, you have your hand on top of it, the $21,000. Now, who owns it? Does the bank own it, or do you own that money? Do you have the will to spend it the way you want it, or does the bank has the will to spend it? Bank has no right. They have given it to you. Who owns that money? You own that money. So, that is where it becomes an asset for you. It's a liability. Yes, of course, the loan is a liability. The cash is an asset. Please note, the cash what you have in hand is not the loan. The cash what you have in hand is what you own. The loan independently is a liability. I twist that example a little more. Suppose you take the 21,000 in hand, you are carrying the 21,000, you are about to put it in your bag which you carried to the bank, and there is a burglary in the bank, and the $21,000 what you had in your hand gets snatched away by the robber. Then who owes that money? You owe the money to the bank. Bank is not responsible, it is your money. because the bank has given it to you, you have put your hand on it, moment you have put your hand on it, it's your money. So it is something which you owned, you lost it. The liability, loan liability will still remain as it is. So loan liability is, the loan is different, the cash is an asset that you have. The loan what you have taken is a liability, and that is what you see in this. I hope I am made it little more clear at this stage. I go back and read the statement again, continue reading the statement. And used this plus 35,000 of the partnership fund. Please note, what is the partnership fund earlier? The partnership fund earlier was 48,000, as you can see in the formula bar out here. 48 plus 21, the what do you call it as the cash that was there, the partnership fund was $48,000. So use this, that is they have used the $21,000 cash that is there borrowed from the bank plus $35,000 in cash, that was the partnership fund. So 35 plus 21, 35, 45, 55, $56,000 they have used out of what do you call it as the $69,000 out there. They have used about $56,000, 21 plus 35, 21 plus 40, 35. 21 plus 35, it is about $56,000 is what they have used. Now let us see what have they used it for. Used to buy out the previous operator of the cafe. Used to buy out the previous operator of the cafe. So they have paid this money, they have utilized this money. Now is utilizing the money not an expenditure? Let us read that. What have they utilized for? We have to understand. If utilization is there is something which has been consumed, then we will take it as expenditure. It just says utilized. Let us further read the statement. Of this amount, 53,200 was for equipment. Please note, equipment, you bought an equipment. How much money they have utilized? 35 plus 21, that is $56,000 they have utilized. Out of that $56,000, they have bought an equipment for how much? $53,200, as you can see on the screen out there, $53,200, they have bought an equipment. When they have bought an equipment, who owns the equipment? Lone Pine Cafe owns the equipment. When Lone Pine Cafe owns the equipment, what is it for Lone Pine Cafe? It is an asset for Lone Pine Cafe, 53,200, that is equipment out there. It's an equipment, they have bought it and it's an asset for them. They own that equipment. Whatever, what is the equipment? It might be anything. It might be an equipment to cook, it might be an equipment to freeze, it might be any equipment. I don't have the details out here. Next I am going to read the statement again. I have not finished the transaction yet, I have not finished the statement yet out there. I am still reading that statement out here in this particular case at this stage. I am just reading that statement out here. It says that of this amount 53,200 was for equipment, $2,800 was food and beverages then on hand. That is F&B, food and beverages. Imagine that what is called as packets and packets of what do you call, some packed snack out there, and there are some soft drinks out there, cartons of soft drinks that they have. That is also what happens. It is now they have paid for it. How much they have paid? They have paid about $2,800 for it. And what is it? It is F&B. Sir, why is it an asset? Once you have bought it, who owns it? I have bought a crate of soft drink. Who owns that crate of soft drink? Lone Pine Cafe. Who owns that crate of soft drink? Now, that soft drink, once it is consumed, then it will become what is called as I will take it to expenditure. Once it is sold, I will take it to revenue. As of today, I have paid $2,800. I have bought crates and crates of soft drink and packed snacks out there. So, it is what we have bought. So, what is the amount that they have spent out there? The cash they have basically spent is $56,000 out there. 35 plus 21, $56,000 they have spent. and bought an equipment as well as bought some food out there from the previous cafe. So 53,200 plus 2,800 is 56,000, and that is exactly the amount they have basically paid. When you pay that, the cash balance reduces by 56,000. Now what is the cash balance you have? 13,000. You have 2,800 of F&B, food and beverage, equipment of 53,200, and this is how the balance sheet basically looks like. Let me go back and read through it again further. Let me go back and read through it again. And the partnership paid 1,428 for local operating license good for 1 year beginning November 1st. The partnership paid 1,428 for an operating license that is good for 1 year. Now again, somebody can say, expect cash, what happens? When you are paid, what happens? Your cash balance basically comes down by how much? My cash balance comes down by 1,428 when I have paid. So fine, asset comes down. Now what is it? Is it an expenditure? Well, no, it is an operating license. I own an operating license. I have not utilized the benefits of that operating license. It is valid for 1 year. Every month I utilize the benefit of that operating license. So, for example, $1,428 is what I paid for operating license, and at the end of 1 month, what is the value of the license still remaining? The value of the license still remaining is only for 11 months. So what happens? 1428 divided by 12, 112 or 1428 divided by 12, because 12 months out there is 1 month's utilization. I have basically utilized out there, and that I will write it as an expenditure in the income statement out there. I am not calculating at this stage. So I have utilized, for example, you have utilized it for 3 months. Then still 9 months is left out there. 1428 into 3 divided by 12 is what you have utilized. That I will write it in the income statement. The rest unutilized will still remain in the balance sheet because it's a license which you own. You can sell it maybe. So what we are looking at? We are looking at the balance sheet. That is, what is it you own? You own the license. It is like paying subscription for your phone for the next 1 year out there. I mean, you have paid in advance. But as far as the company is concerned, you have unless you utilize it, you cannot write it as an expenditure. You can only write it as paid in advance. The company is concerned, they have received an advance. It is not an income. It will become an income only once you utilize the benefit of it. So that is what basically the similar in this particular case. I move further. And paid 1,400 for a new cash register. New cash register. Now paid 1,400. Moment you say paid 1,400, what happens? My cash balance goes down. And what have you done? You have bought a cash register out there. That is, you have bought a cash register. Cash register is that machine, cash register, the machine which you use for entering and keeping cash and everything, and that is owned by whom? Owned by the cafe. So yes, cash goes down, your another asset basically has increased in the process, what you actually see out there. Now I am not finished, let me go back in this particular case. It says that the remainder of the 69,000 was deposited in a checking account. That is, what is the remainder of that 69,000? The remainder after the 69,000, how 69? 48,000 capital, 21,000 borrowing, total of 69. What is the remainder? Remainder is 10,172, and that is deposited in a checking account, basically a bank account. So what happens when you deposit in a checking account? The cash that is there, basically 10,172, basically becomes 0, and you own a bank account. The money that is there in the bank is your money. The money in the bank increases, that is also owned by you, and that's an asset in this particular case out there, and that is all basically that happens out here. So you might say the total is not balancing. Let us look at total. Why total is not balancing? Because lease. I have not entered the lease. Yeah. Because in this particular case, if we talked about the lease out there, 1428, the lease. You purchase the lease. Who owns the lease? Lease is owned by you in this case. I reduced it from the cash. Agreed. I missed to enter then. I reduced it from the cash, as you would have seen out here. Reduced it from the cash. But who owns it? You own it. It's an asset for you. So operating lease out there. Operating lease out there is owned by you, that is another 1428. So the balance sheet as on November 2nd looks like this, with capital, borrowing, these are some things what you own, and it is about 69,000 in this case. Now what I want you guys to try is, try this second question. If you actually see the case out there, the case talks about prepare a balance sheet of Lone Pine Cafe on November 2nd. We have done this. Now prepare a balance sheet as of March 30th, 2010. Now I want you guys to try this on your own. I want you guys to try this on your own. Right? And then I am going to do it out here, but I want you to try and see if you can solve it, and then refer back to my lecture on how we have gone about doing it out there.